Good morning from sunny but cool Chicago, where we anxiously await the Chicago Bears' first regular season game on Monday Night Football versus the Minnesota Vikings here at Soldier Field. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, September 7th, 2025. In today's podcast, our focus is on the S&P 500's current 35% rise from the April lows, but now amid deteriorating internal health that warns of its vulnerability to an overdue corrective decline. We have captured most of this rally as we move back into the market on April the 23rd, but now our focus is on making sure we keep most of these gains by avoiding the next and inevitable corrective decline. Before we get started, here's a little bit of information about us. Asbury Research is a registered investment advisor. We're an RIA, and we've been providing both investment research and asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have two levels of research service that are available. Number one, we have our Asbury Premium for more serious investors, which includes the latest updates on all of our data-driven models and some personal instruction on how to implement our tools into your own portfolio. We also have our entry-level Substack newsletter, which I'm going to go to right now, asburyresearch.substack.com, which is $25 a month. It's an entry-level kind of introduction to our research. It does not include any of our trading models, but has selected portions taken from the premium research product. There is also a free version of this service. So if you like our videos and our approach to markets, I strongly suggest that you sign up for the free version of the Substack newsletter. Again, asburyresearch.substack.com. It's a no-brainer. If you like our research, you really should be getting this. And you could do that, again, right here from the website. We also offer managed accounts for both individual investors and financial advisors and portfolio managers as a third-party manager. We're actually starting to do a lot more business in this area as asset managers. We'd be happy to schedule a quick Zoom with you to show you our 4 model portfolios, how they have performed this year, and see if it might be a good fit for you or for your clients. Year to date, 3 of our 4 model portfolios, Asbury Aggressive, Asbury Balanced, and Asbury Conservative, are all outperforming the S&P 500 by various amounts, various degrees, but with lower drawdowns and better risk-adjusted numbers than the S&P 500. That's really the key to what we do here. Our number one focus is managing drawdowns, making sure that our clients aren't taking big hits on the downside and then trying to capture as much as the upside as possible, lowering volatility in the accounts, and generally making it easier for our clients to sleep at night, especially under these times when we're still trying to figure out where we're going with tariffs and interest rates and some of our geopolitical relationships. The other one of the 4, our Asbury Ultra Conservative model, the only portfolio that is not outperforming the S&P 500 this year, is trailing the S&P by about 5% year to date. But the maximum drawdown in this particular portfolio is only 6% compared to a 19% drawdown that we've had in the S&P 500 this year. So if you're an older, very risk-averse investor, this model might be a great way for you to pursue getting a better yield than short-term treasuries, but without the risk of the S&P 500 and without the volatility of the S&P 500. Contact us right here via the contact tab at asburyresearch.com if you want any more information or a prospectus on any of these model portfolios. Before we get started at looking at markets and the current signals on our models, let me just take a minute to share a conversation that I seem to have all the time with investors regarding performance. So what I did is I actually went to Google and I just asked the AI version, how many money managers beat the S&P 500? We get that all the time. There seems to be a misunderstanding about performance, and a small fraction of money managers, roughly between 8 and 20%, depending on the time frame, beat the S&P 500 over long periods. The vast majority, approximately 80 to 92% of actively managed large cap funds, have historically underperformed the S&P 500, especially over a longer investment horizon. This Again, this is due to challenges, high fees, market efficiency. There's a whole lot of reasons. While some managers do outperform in a given year, consistency is rare, making a low-cost S&P 500 index a more reliable strategy for many investors. What they don't talk about here, and what many people don't talk about, is the drawdowns. As you get older, as you can tell, I'm an older American. I'm still working, but I'm getting into those years where a lot of people retire. And what they don't tell you about is, what about the drawdown? If you draw down, let's just use this. So this is showing the drawdowns in green and the recovery needed to get you back to where you were before the drawdown. The last big drawdown that we had, well, we had a 20% drawdown this year. So if you draw down 20%, you have to make 25% on the way back up just so you could break even. If you were trading or if you were investing during COVID drew down 34% top to bottom. This was back in 2020. If you drew down 30%, you had to make 43% just to get back to where you were. As you get older and as you start actually drawing out of your account for retirement, if you're that age, that's just going to compound whatever you get for a drawdown. So this outperforming the S&P 500 is great. If you can outperform, or if you can market perform the S&P 500 with significantly less drawdown, less volatility in your account, that to us is really where you want to be. That's what we strive to do. Okay, so enough there. Let's get started. Let's look at some of our models and see what's going on in the markets. So we're going to go into the Research Center, which is the paywall. And then we're going to go take a look at the Asbury 6. So the Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health. I like to call it the EKG for the stock market. It's updated every day about 2 hours after the close in the Research Center. And via 6 different metrics, it shows you what's really going on under the hood of the market, and rather than trying to chase the S&P 500's tail as it oscillates all over the place. The day-to-day volatility in the S&P has really increased over the past 5 years or so. That's what this is for, to keep us avoiding the noise and following the signal. So the Asbury 6 shifted back to a positive bias on August the 12th from negative on July the 31st. You can see all 6 of the constituents are green. If we roll down here, we can see this is very active. Its averages annualized going back 8 years, about 11 round turns a year. In other words, a round turn would be from going positive to negative. Positive is green and negative is red on the chart. So we went to negative on February 21st. We had a little chop back and forth between the latter part of March and the very early part of April. And then we went back to negative. We got back in on April the 23rd. We had a little bit of chop here between June 17th and 23rd. And then we went back to positive again. And we had another little wiggle here, but now we're still positive. Again, the Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected via quantitative backtesting. We basically looked for 6 diverse market indicators that were unlike each other, that tended to work better as a team than individually. Individually, every indicator has an Achilles heel. Nothing works all the time. But by using this keeps us in the market and gives us a better indication of what the market's feeling rather than, again, trying to watch all the gyrations of the S&P 500. 4 or more green indicates a positive model. 4 or more red indicates a negative model. Year to date, the A6 has slightly outperformed the S&P 500. We'll take a look at it. Take a look at that. Go. So year to date, slightly outperforming the S&P 500, but with half the drawdown. The drawdown in the S&P this year has been 19%. The drawdown in the A6 has been half of that, about 9.6%. So you can see the A6 is in green and the SPX, the S&P 500, is in blue. But the upside is if you go all the way back to inception here, which is Q4 of 2017, the Asbury 6 has outperformed the S&P 500 80% of the time during this period, or 1,668 of the 1,942 trading days through the end of the second quarter of this year. Again, the Asbury 6 is a part of our premium research service. Next thing we're going to look at is, let's go back into the research center. And we're going to look at our CPM, the correction protection model, right here. CPM is a component in our various portfolio, our managed portfolios. It's a risk on and risk off type of a situation, just like the Asbury 6s. But the difference here is it's got a component in it to try to keep us in the market as long as possible, because the stock market has an inherent upward bias. Bonds don't have that. Foreign exchange doesn't have that. The commodities don't have that. Stocks do. We try to take advantage of that. So we went risk off here on December the 18th of last year. Got back in because it was a short-lived move down. Caught pretty close to the top, short-lived move. We went back in. We went back to risk off on February the 25th. And outside of just about a week or so in between late March and early April, we stayed risk off. We went back in the market on April the 24th, and here we are now. About 5 round turns a year, 5 times going from risk on to risk off per year, which is a lot more palatable for most investors. CPM is a completely data-driven, dynamic stock bond allocation model. It was designed to be an alternative to the standard 60-40 portfolio. Here's what I'm talking about here. Let's go back and take a look. This is AOR in blue. AOR is an iShares product that emulates the 60-40 stocks and bonds portfolio. Typically, if you use an advisor, you can have something that's similar to, on the order of 60-40 stocks and bonds. So this is since the inception of CPM, which again is Q4 of 2017, and you can see basically CPM has doubled that 60-40 portfolio over that time, and it's done it with about the same beta and standard deviation, but a lower drawdown. So this is what we're trying to achieve. We're trying to achieve market-like performance with lower drawdowns, lower volatility. This means a lot to older investors that are either nearing retirement or getting close to retirement. Let's go back into the website, and now we're going to look at sector rotation via our CEF model. So we're back in the research center. You can see all of our models are up top for easy access. So let's go into CEF and see what's happening here. So the CEF model, here's the graphic for the CEF model right here. The CEF model, if you're not familiar with us, is a completely data-driven sector rotation model. It was created to quantitatively identify long and overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sector spiders, which together are the S&P 500. The CEF model is always fully invested in the market, providing investors with a dynamic alternative to the traditional buy and hold portion of your portfolio. Most investors that I know, they keep a certain part of their portfolio in the market all the time. Sometimes it's 25%, sometimes it's 75%. It all depends on the individual, it all depends on the portfolio. But what we wanted to do for that part of the portfolio is, instead of just sticking it in the S&P 1500 or in some kind of a broad index for broad coverage, we came up with an algorithm that measures the speed of assets moving in and out of the various sectors of the S&P 500. The model's updated every week, and we always trade the top three. The top three according to our scores. So the way you read this is the communication services, and this is for next week, was number one in the trading time period, which is a business week. It was number three in a tactical time period, which is a business month, and it was number two in a strategic time period, which is a business quarter, for a total score of 6. It's like golf. The lower the score, the better, the more assets flowing in. So you can see we've got XLC, XLF, and XLY this week. The ones where most of the money is coming from to go into these sectors is the bottom: energy, industrials, and technology. Note that if you're a regular watcher here, CEF had been overweight technology for the past 4 months, and I think we picked off about 9 or 10% of relative outperformance versus the S&P 500 during that period. Look where it is now. It has really fallen. Why does that matter? Because technology typically leads the broad market higher and lower. Now that on a sector basis, we have money coming out of technology, that worries me about the vulnerability, about the sustainability of this decline. And we're looking especially hard at when the next correction is going to begin, so we could lock in for our clients and for ourselves the money that we've made by being long the market since the last part of April. So the A6 CPM model and the CEF model are all a part of Asbury Research's premium research service. Contact us again right here via the contact tab at Asbury Research if you want more information, details, and pricing on any of these. So we talked about drawdowns, which is important. The next thing I want to do is let's stay in the research center and let's look at one of our standard reports that we do every week. It's called Keys to This Week. And what we do is we probably look at 100 charts or more every week, maybe 150. I never really counted them. But for Keys to This Week, we try to find the 10 charts that we think are the most germane to what's going on in the market right now. So that's what this is. Let's go there. And we're going to look at not all of these, but some of these. So we have market is weakening internally. Watch the Asbury 6 and CPM for a top. So let's start out with the second chart. This is the NDX, which is a NASDAQ 100. It's a larger, it's the top 100 tech stocks in terms of market cap. Takeaway here is that on April the 28th, NDX started outperforming SPY on a quarterly basis. That's what the green line is here, 63-day moving average. That led to all the strength in NDX and in the overall market, the S&P 500, for the latter part of April, which we've been long from, according to CPM and according to the Asbury 6. Look what's happened here as of August the 19th. It is now underperforming. That is not good. That means one of your key leaders and the larger part of the Mag 7, all those big cap names, those huge big cap names like your NVIDIA, Microsoft, and others underperforming. Let's go to the next one. This is SOX index on top. That's a Philips semiconductor index. I'd say anecdotally to a secondary degree, the SOX index also tends to lead during periods of market strength, tends to lag during periods of market weakness. So on May the 9th, SOX started outperforming SPY, the S&P 500 ETF, as of May the 9th, and which is right here. SOX has gone higher since then. S&P, everything's gone higher since then. Look what's happening here. SOX is now underperforming the S&P 500 as of August the 29th. So two of our typical leaders in a bull market are no longer leading. This next chart is just a tool that we have in-house here that we've developed, Jack and I have developed, just to tell us what the risk appetite is in the market. We've got the S&P 500 up top here since January. Down here, we have the relative performance of GBTC, which is the crypto ETF, versus AGG, which is the aggregate bond index ETF. On April 22nd, note all these Aprils showing up in here. That's really when the rally started. April the 22nd, crypto started outperforming aggregate bond index, meaning the risk appetite was really accelerating. People were looking to take bets in the market. Look what's happened since August the 25th. Crypto is now underperforming ag. So these three things, I mean, if these change, then that means the market healed itself. But right now, it's telling us the market's vulnerable. The last one of these, I'm going to look at seasonality. I look at seasonality in kind of a tertiary way. I've never made a trade on seasonality, but when seasonality is as an opinion, let's call it, like it does now, September is the seasonally weakest month of the year, according to the S&P 500. And then I'm seeing all this underperformance. I'm seeing this lack of appetite for risk. That means something to me. And we also have a version of this chart that breaks it down into more of a quarterly standpoint. So seasonality doesn't really start getting better until the third week of October. So we've got a little window here for about a month or so where even seasonally the market's vulnerable. The last thing that we're going to look at today is our sort report, and that is a part of our Substack. So here's the sort report. This is not a part of the free part of the free Substack, but it is a part of the $25 per month version, paid version of our Substack. And I want to take a look at that, show you what we do here. So there it is. I made it a little bigger so we can see it. Again, it's part of our entry-level Substack online newsletter called Asbury Research Chart Focus. The sort report tells us which parts of the global market have positive trends, are outperforming their benchmarks, and have positive asset flows, which means that new money is coming in and pushing those ETF prices higher. We see it as a very low-cost way to make better investment decisions based on data and not opinion or economic forecasts. To us, forecasting is a euphemism for guessing. We just believe in following the money. What this does is we look at, I think there's 9 or 10 here. I guess I never counted them. But we look at a lot of different asset classes. We have U.S. small cap, gold, emerging markets, U.S. interest rates, commodities, global equities, ex-U.S., technology, crypto, crude oil, and the U.S. dollar. And then we look at them in terms of trend. Does it have a positive trend? If it does, it gets a green sell. What about relative performance versus its benchmark? If that's positive, it gets a green sell. Money flows. Is there assets expanding in these ETFs to drive the prices higher? So, and then we look at the ones that are green all the way across. This is where we look for value. We're looking for value in small cap. We're looking for value in gold. We've actually been long the gold miners, RING, since August the 8th. And it's up, I think, 16%, and it's beaten the S&P by 13 or 14% during that period, which is exactly a month. It'll be a month tomorrow. We started looking at gold because the sort report told us that we were clicking on those three cylinders: trend, relative performance, and money flows. So this tells us we should be looking at small cap, gold, emerging markets, and interest rates for opportunities. So there you go. Let's get back to our homepage here. And that wraps up our latest Asbury Research Following the Money podcast. Our next Following the Money is tentatively scheduled 2 weeks from today, Sunday, September 21st. I hope to see you. I hope to see you then. In the meantime, if you have any questions or want any more info about any of the research or models or model portfolios that we spoke about today, again, you can contact right here via the contact tab at asburyresearch.com. Don't forget to like and subscribe. Have a great Sunday and go Bears. See you in 2 weeks.